Good evening, everyone. Hello, Williamson County, and thank you all so much for coming to this free seminar of How to Repair Your Credit, hosted by Josh Rogers. I'm Katherine Johns, and I'm excited to introduce to you your host this evening, and he works for Castle & Cooke Mortgage, and he, as well as his board and panel of experts, are going to share their tips and how to repair your credit. And after the seminar and after they talk, they will open the floor up for questions at the end. So please help me welcome Josh Rogers.
Hello, Williamson County. And thank you all for being here today. It's so wonderful, and we're glad to have our local business members with us. I'm Josh Rogers with Castle & Cooke Mortgage. I'm the Tennessee area manager, and we thought it would be a good idea to give back to Williamson County on how to repair your credit. I mean, so many people come into my office every day, call me on the phone, do online applications, and they can't get approved, and they wonder what they need to do. So many of the bigger banks and other places out there just push people away and don't give them the real answers that they need, you know, and they don't really help them to the next step. And so it's kind of like this void therein of, how do I fix my situation? No one's telling me. They send you here, they send you there, they don't really give you the right information. And that leads me to the credit expert, Eric Wheeler. He's with Accelerate, and he's going to help us. And John Cherry over here with Big Dog Realty, he has an extensive career in Williamson County and runs up. He's also a property manager as well, so he pulls credit for people that just want to rent. And over here, Gary Ward, he is a financial planner, and he sees people coming in and out of big dollars every day. And Laura Perry, she's a local attorney, and she does real estate law, and she can help answer some questions. Eric Wheeler,
Awesome.
Can you give us some
tips? I can get some tips. I kind of want to take us a little bit and talk briefly about what the effects of bad credit and the long term and how much it can actually cost you. So I would call this probably the high cost of a low credit score. I don't think people really understand the depth that credit actually affects you. It can affect things obviously like your credit or your car insurance rates, or your auto loan rates, your mortgage rates. And if you just look at an auto loan, let's just say an auto loan costs you an extra $100 a month because of the interest rate that you've had to do, because you can't get the 5% or the 6%, you have to get the 12 or 15.5%. So let's say that, or more, right, depending on what your credit score actually is. And if you flip that over and translate that over into a mortgage in the course of 30 years, and you look at that, could cost you $200-300 extra a month. So now all of a sudden, bad credit just on the auto loan front and then your mortgage front could cost you $300, $400, $500 extra a month. So that's where the value of really understanding the extent to which bad credit can affect you. It can affect your homeowner's insurance. It could potentially prevent you from getting a job. That's calculated, I think, at $6,000 or $7,000 annually. So when you look at that over the course of a year, let's just say it was $400 a month. That's your auto loan and your mortgage, or your auto loan and then your mortgage is costing you is $4,800 annually, plus your loss in a potential new job. So now you're up around $12,000 that bad credit's costing you. So there is obviously a value to having a good credit score. Before I really jump into that, let me briefly kind of talk to you about the FICO score.
Let me get this right. So
yes,
you have to pay more.
Correct.
Because of a bad credit score.
Absolutely.
You always have to pay more, and so how do you ever get out of the hole? It's just like, it's never ending.
Right.
So I guess that's probably what you're leading to next, and it's a...
Right, well, yeah, what I want you to understand is that everybody's heard of the FICO score. Does anybody know what that means by chance? what it kind of translates to, what it's from. The FICO score, what is a FICO score? FICO score is a short way of saying it's the Fair Isaac Company. It's the acronym for the Fair Isaac Company. And this company is responsible for the development and implementation of analyzing and predicting what's likely to happen based on predictive analysis. Now, it's a bunch of mumbo-jumbo to basically say they watch your habits and see how you've spent in the past, and based upon those actions that you've had, they can predict how you're going, if you're going to be faithful to follow through on paying back your mortgage. So that FICO score determines what you can get credit on. Did everybody follow that? So when you go to a mortgage company, that's something that's looked at because they do this predictive analysis. They look at your FICO score, the analysis that determines whether or not you can pay back your loan. And I don't know about you, but if I were to loan somebody money, I want to know that I'm going to get paid back. And that's kind of what they look at. They look at the risk. So it's an assessment of the risk. What is your FICO score comprised of? Does anybody know kind of some things that are all in there? We'll talk about that. Your payment history makes up 35% of your FICO score. So when you look at your credit report and you look at your credit score, your FICO score, that 35% of it is actually determined on your payment history. So they want to see that you've actually paid your bill, paid your bill, paid your bill, paid your bill. I mean, it's almost obnoxious how far back they go, but they just want this little check mark. You've all seen it. Okay, okay, okay on your credit reports. That's the payment history. They want to know that you are a consistent, consistent with paying your bills. So that's 35%. Debt amounts owed, that's another 30%. That's your debt to income ratio. And I can talk about that too in a minute if you'd all like when you go that direction. Another one is 15% is made up of the age of your credit history. So they want to be able to look and say, okay, well, they have 10 credit lines, and all of them have been there for over two or more plus years. Whereas it's not like you just go out there and get 12 credit lines all of a sudden. You're opening up credit cards at Best Buys and JCPenney's and Macy's, and now all of a sudden you want an auto loan, and then you go over here to him and you want a mortgage. It's one of those, that's all factored into the high risk, and that would come into play with the FICO score. New credit inquiries. That's 10% of your score is comprised of new credit inquiries. And just kind of one of those mental notes for you all, every time you have an inquiry on your credit report, it's actually a negative 6-point effect. Just to kind of throw that out there. When you go to get an auto loan, if you aren't ready to pull the trigger, one recommendation would be don't have them pull your credit, because what they do generally is they farm your score out and they see who can come in with the best rate. And they say, hey, I can get you a 6%, and this guy can get you a 10%, and the list goes on. The problem is they'll hit you 12 to 18 times and do the math on that. Now, maybe only the first 3 or 4 negatively affect you 6 points, but the point is you get dinged a lot real fast, and that can negatively affect you over time. So that's 10%. And then another 10% is the mix of accounts or the types of credit. Just simply meaning you credit lines. What kind of credit lines do you have? If you have an auto loan, a mortgage, some credit cards, and all these student loans and everything else, all of a sudden you've got this mix of credit that's available to you. So those all come into play with the FICO score. So what negatively impacts your FICO score? Obviously, it's going to be not paying your bills. Collections, late pays, too many inquiries. If you're excited about getting credit, you go out there and get a bunch of different stuff. Bankruptcies, judgments, liens, repossessions, excuse me, the list goes on. So essentially what you want to do is we really want to protect this FICO score. So the question is, how do you do that? And I guess some quick tips, if we want to kind of give you kind of a summary of everything, would be a good utilization of your credit balances, making sure that you're not maxing everything out. And I can go into detail on that. In fact, I will, unless somebody else wants to chime in.
What is
or have any
that
questions.
magic? Because I hear about that. Okay, say your credit card is $1,000 limit.
Yes.
When does it, you want to charge on it, you want to spend some of the money and pay it back.
Sure.
When does it start to negatively affect you as far as your limit, your balance to your limit?
Well, I think the industry standard would be before a mortgage company would give you or wants to give you a loan, they really want something called your debt to income ratio at kind of that perfect place, so to speak. Is there a perfect place? That's kind of hearsay. The number that's kind of going around in our industry is 10 to 30%. 10 to 30%. And let me kind of be clear on what your debt to income ratio is when a mortgage company looks at you. I'm not talking about like your, this isn't your cell phone, this isn't your Netflix account, this isn't your Best Buy card, it's not that sort of thing. This isn't your GQ magazine subscription, I'm sorry to say. It's more than that, it's your, do what?
I said thank you.
Yeah, you're right. I'm talking about your debt payments. Your debt payments, and that's not forms of entertainment or food or utilities, okay? That's a lender wants to look at your debt to income. Most mortgage lenders, need that to be under 45%, okay? Meaning, let's say you have a gross monthly salary of $4,000 a month, okay? That means you should have no more than $1,800 a month in debt payments, and that includes your mortgage. Everybody follow that?
Include your mortgage.
That includes your mortgage.
So you're
yes.
talking car payment, credit cards.
Yeah. Revolving debt payments.
Student loans.
Exactly. Yeah. Things that are obviously a monthly set in stone kind of bill, the recurring kind of things, and maybe someone else can chime in on that if you'd like. But go ahead.
Child support and alimony.
It's not listed on there unless you have a collection. That's been my experience.
I believe that's accurate.
So if you're current.
You're current, you're good. Yeah, it's not on your credit report, so it won't go into your debt to income.
But IRS liens are.
Yes, IRS liens, so if you don't pay your IRS bill, or you make a payment arrangement with them, a lot of the times it will show up on your credit report sometimes, right?
Correct. Yeah, whatever, yeah.
And so that will go into
Correct.
our debt to income ratio.
That would. Yeah, the main thing, and I can't say this enough and stress this enough, is you just want to stay current. You don't want to get behind. I know that's kind of one of those, well, what if I do kind of situations. We'll get caught up quick. So, because it's really about consistency, and it's really about, just making sure you get that little check in the box. And I hate to say that it's political, because it's really not, but it is in the sense of they just want to see what they want to see, and what they want to see is consistency. Oh dang, I could write a rap off of that. Just kidding. So they just really want you to be consistent. Another thing is a mortgage company. So outside of debt to income ratio, the other one that's a big deal on the credit front would be your percent of available credit, or your utilization of your credit lines. Okay, utilization. So, and that's kind of where we were going with you on the 10 to 30%, kind of the sweet spot on your credit utilization. So basically, you want to pay your credit cards down to that 10 to 30%. A mortgage lender, and you can correct me if I'm wrong.
So if you have $1,000 limit, you want to be under $300.
Under that $300, yeah, between $100 and $300. And it's kind of interesting, because if you start going under $100, you think you're in happy land, because you're actually under that 10% mark. But ideally, for your credit score to continue to climb, you really want it to stay between 10 and 30%.
Wow.
And that is kind of a not exciting thing if you think about it, because if you look at, let's just say you had $20,000 of available credit on these different cards. So now you're telling me in order to stay in the sweet spot, I have to, have between $2,000 and $6,000 of debt, is essentially what I'm saying. And yes, unfortunately, that is exactly what I'm saying.
All right, so Eric, if you already have an 800 credit score, you don't need to play that game. But if you're
Correct.
580 and you're going for 620 to get a loan,
Correct.
then you should do that. You should
Absolutely.
pay a little interest to get to
Absolutely.
that point.
Well, and there are safeguards, and there are ways that you can go about accruing credit without just running crazy rampant into debt on things that because you don't want to go $6,000 in the hole. Let's just be honest. I don't. If I had $20,000, I wouldn't want to just go spend $6,000 off the bat. But if you wanted to do like a secured credit card, I know that, and I'm not advertising for anybody, but Wells Fargo and a couple of other of these banks can do a secured credit card, and what that is you actually give them money to protect basically your credit card.
So what you're saying, if you can't get a credit card,
Correct.
you're up against this wall and you can't get a credit card. So the only way to do it is to get a secured credit card.
Absolutely.
Is put your money in the bank and they give you a credit card against that money.
Absolutely.
Most
That's
of them
exactly how
have
that works.
a deal where you can go in with $300.
Yep.
And they put that in a savings account in your name, but it's secured. You can't touch it. and it's collateral for the $300 limit credit card.
Absolutely.
Which you don't want to go over $100, or actually about $90 is 30%, I think.
That's right, that's right.
Okay.
And so, do you have, I guess it depends, because on credit, now give me if I'm wrong, is that it's you're outrunning some of the bad accounts, right? With a
Correct.
new good account?
Correct.
Is that how you get a better credit score?
Well, that's kind of where the credit history comes into play, because the temptation is for us, I know I'm one of them, I'm guilty and done it, where you fight against this credit card for so long and you finally pay it off, and you get so excited, you and the wife do a dance around the house and you cut it up, throw it away, and you close the account.
Ooh, yeah.
And that is a negative. That is negative.
You lost all the history.
Exactly, you lost your credit history. You would much rather have that still open on your credit bureau and your credit report.
Now, if you have 10 of them, you can cut up 7 of them and keep 3.
Sure.
Okay.
Well,
How many trade lines you have?
Keep the old ones.
Keep the oldest ones?
Yeah, keep the
Cut up
old
the
ones.
newest ones?
Yeah.
Correct. Is that the strategy?
The thing is, you don't ever want to open a credit line and close it if you can avoid it. If that's kind of to put it simply.
Now, what we're talking about is revolving credit.
Revolving credit, yes.
And that means credit cards, for the most part.
Correct. And
And-
because those are the easy way to get, that's just an easy, quick credit line, yes.
And does revolving affect your credit more than installment loans? Have you ever noticed that?
I don't know if it necessarily affects you more. It's just a different part of the pie that's factored into the FICO score.
Okay.
Yeah, the thing is, from a financial planning point of view, is that when you have a lot of credit card, you have a lot of risk and exposure to using it.
Mhm.
Correct.
You know, if you're gonna keep a card open, you don't need it, literally put it on ice. Put it in a tray, freeze it, throw it in the freezer,
Right.
so you don't have to get to use it.
Yeah, that's
But
good.
again, we want to do a step, when you're looking at reestablishing your credit, pull your credit. Go to the annual credit report and pull up on it, and look for bad information. And you can do it, it's annualcreditreport.com. You can do that once a year, no charge. Why do you want to pull your credit at least once a year?
You need to see if it's false information.
Absolutely.
False information, bad information, or identity theft.
Mhm.
Correct.
It's a big issue out there now. So you can have stuff that you know, like, wait a second, this isn't mine. You can rebuttal anything that's on there. So that's another way of improving your credit score, if there's something out there. If you're unemployed, you can always go back and write a letter to the credit bureau addressing any issues. You have rights under the Fair Credit Act. You gotta be able to use them. But you were talking about the biggest issue on debt or credit is we tend to live off of our wants and not our needs.
Correct.
Mhm.
You know, you need transportation. Well, I want the BMW. No, you need transportation.
That's right.
We buy stuff or do things to impress people who really don't care about us. If you look at what's important to you and your family, you can control where you are. And then coming back to establish your credit is looking where you're spending your money. Because if you don't track where you spend your money, and there's several different systems to do that, you're gonna get yourself in trouble.
Is there one you can recommend?
Well, if you go to the Financial Planning Association website or the Foundation for Financial Education, they have 4 basic systems they use. Ever heard of there's a calendar system. We just basically put your bills on, you put when the bill is due, you put it on a calendar, you pay as you go. There is the envelope system, which Dave Ramsey's made famous, but it's been around long before him, probably through his grandmother, if not my great-grandmother. You have the register system, but most people use the 4th system. You know what that is?
Yes.
Leftover system.
Right.
What's left over is what I got.
Right.
But if you put down and figure out your expenses first and you track where your money in coming out, then that's your first step for repairing your credit, because then you know how to do it.
Absolutely.
Credit is just a tool. It's neither good or bad. How you use it will determine whether it's good or bad to you.
That's right.
One tracking system that I kind of recommend, it's free. It's mint.com,
Yeah, that's
Again,
good.
this isn't, I don't make any money off this, that's free. But literally, do a MINT, yes, and you can literally upload your checking accounts, credit cards, auto loans, mortgage, whatever it is, and it will literally keep track of everything you spend and break it down, and you can set budgets for everything.
And most financial institutions are coming up with similar type programs.
Awesome. Yeah, they should be similar to that. And just kind of a little note for you all as well, that 79%, because you hit on identity theft, 79% of all credit reports have an error. Nearly 8 out of 10 people have an error on the credit report. Now, does that mean all errors actually negatively impact your credit report? No. Or your credit score, excuse me? No, it doesn't. It just means that something's crossed over. Some of the biggest things that will affect your credit negatively are going to be duplicate accounts. I worked on a lady's credit report the other day because we do credit repair, but I worked on somebody and she literally had the same thing show up 4 or 5 different times. And it was something as significant as like a bankruptcy or collections. And the problem with that is now your bureaus, it's not only looking like, oh, look, there's a bankruptcy, next thing, and they move on. It's there's a bankruptcy, there's a bankruptcy, there's a bankruptcy, there's a bankruptcy. And you want to talk about negative impact on your credit. And when these guys start making duplicate accounts, that'll severely impact your score.
Yeah, what we look at, one of the tail signs for getting a mortgage is if you had a bankruptcy, what was your track record after the bankruptcy? And it's called derogatory after bankruptcy.
Right.
And if you've had multiple bankruptcies, that's another issue. Now that really hurts and that takes longer to overcome. But however, you can overcome it. And as John, you're in the real estate world. People are coming to you, not only to buy a house. Hey, what are my steps? Well, if I can't buy it, what do I do? Then you being a property manager, you have a solution for that. What are some of the things you look for when someone walks into your office and says, hey, I need to move, what do I do? I have credit issues.
Well, we manage about 25, 30 rental properties in the area I'm in Williamson County, and many of them, actually a lot of them don't even know that they can buy a house. Or
Right.
some of them move here from out of state and don't know the area, and they simply want to rent before they figure out where they are going to buy. But the ones that just assume they can't buy, or say, well, I've had this and I've had that, or I've been through a divorce, and he or she hurt my credit, and they just don't know exactly, or they've been turned down for a car, or they talked to a bank, 2 years ago and were turned down. I ask them a lot of questions, because I want to know if they can buy, or have they applied, or they tried to get approved for a house loan. And I find that about 1 out of 5 that walk in my door, and I get a dozen calls a day,
Mhm.
literally.
Yeah, right.
The rental market is red hot.
Wow.
And so we do a 1-year lease. We pull their credit. It's a very simple process. I get their email address. We log in. It sends them an email, but it charges them like $15. They say, okay, yeah, it's legit, and sends me the report. And I can actually show them or print it out, hand it to them, and they can go start, take it to somebody like Eric and start repairing it. They can go get that $300 credit card, and then if they don't have any trade lines at all, or old trade lines that they closed, and get on, sometimes they're just 2 or 3 months away from being where they need to be. Maybe they're
Right there.
on an FHA, was it 620 is the minimum?
Yes.
So maybe they're a 610.
That's
And
right.
all they need is that extra push to get right over the hump to be qualified for a house.
And usually one secured credit card will do that.
Right.
Yep.
Usually, not the same situation is not for everybody. But it's just
But a brand new car would not.
Right.
brand new installment loans.
I'm looking at the starter home. The reason I got my laptop here is I'm looking at the starter home range in Williamson County. And you're probably not going to believe this, but 3-bedroom, 2-bath homes under $200,000 in Williamson County, there's 54 of them.
Wow.
There's only 22 available. The others are under contract. And that's startling. Now, the lowest priced one, I know because I've shown it, it's at $117,000. It's a foreclosure. Now, let me just give you a little advice. If you are getting a first-time buyer home loan, you do not want to look at foreclosures. 80% of them or more are damaged, and the bank sells them as is. They will not do any repairs, and repairs will be required on first-time buyer loans, because most of the time you're going to get some kind of a government guaranteed loan, and they require repairs. Because they don't want you spending your money fixing the house on that first year. They want you making the mortgage payment.
Right.
So it takes some risk out of the loan. So you want to look at houses that are already in good repair. There's plenty of them. There's 22. And so
Is that in Williamson County?
in Williamson County alone, probably most of those are going to be either Spring Hill or Fairview, just because you're not going to see anything under 200,000 in Franklin, more than likely. And another thing you want to stay away from too is short sales. I don't know if anybody's heard of short sales, but this is where the owner is still the owner of record, but they owe more on the house than it will bring on the market. They're upside down because of the previous market that's crashed, and they still owe too much on it, or it's in disrepair and it's just never going to bring. I just looked at one of those the other day, and let me tell you folks, in 2 words, it's brain damage. You do not want to get involved in a short sale. It'll take 9 months for the bank to make a decision, and it's probably going to be no. A few of those do work out if you're an investor and you already have a place to sleep, and you don't care if it works out or not. But if you're looking to move into a house, don't even bother looking at short sales.
Well, a short sale, just to explain what that is, is this right? Okay, you say you owe $200,000 on a house, but actually with the market and whatever happened to the house, maybe it's only worth $150, or the realtor says, hey, well, we want to just sell it, so let's just get someone offer $150 and see if the bank takes it. Is that what?
Well, yeah. What you're doing is the bank is a third-party participant in that. It's buyer making a contract with a seller. Seller's going to sign anything you offer. Say they owe $190.
Yeah, they have
and
nothing
you
to
offer
lose, right?
$120. Okay, just because you can, and they'll sign anything just to get it under contract. And the bank's not going to accept that. They'll probably take 15% less than what's owed on it, maybe, because they have an insurance policy on it, PMI, the private mortgage insurance, which will probably make them whole anyway, to get close to their mortgage balance. And so they're just going to sit there and wait it out, and they really want to push the seller out of the way and foreclose on it. That's really what they want to do. So they're going to ask the seller for a hardship letter, bank statements, just everything that you would have to supply on a mortgage application. By the time they actually look at this information, it's all expired. They're going to say, oh, we need you to send that the current bank statements and the current pay stubs. And, oh, well, I already sent you that. Well, we need it again. Okay, so they send it again, and they sit on it. And by the time they look at it, they say, oh, what did you look at? No, well, no, it's expired again. So the seller gets very, very frustrated in this process. So does the buyer. You can tell I've done this before, right?
Yeah.
Okay, so
There's another aspect to that is, and the bank begins, the bank that has to pre-approve this short sale
Yes.
begins to negotiate with the seller.
Right.
Is the seller going to sign an unsecured note? Is the seller going to get a 1099 for income?
Right.
There's a whole other host of things that continues to delay a buyer.
There's no guarantee that the bank won't go after the seller for the difference either.
There's
That's
no
right.
guarantee and continue to ruin the seller's credit. So
Exactly.
there's a
They-
lot of things that can
Yeah.
fall apart in that scenario.
The seller might as well just foreclose and just hand the keys to them, is to go through that process.
Well, the good news is
I just want to ask a question.
sure.
So you have a group of people that are struggling to pay their bills. What do they do? I mean, I don't think they can buy a house, whether it's a short sale or whatever, or maybe when the credit repair happens, they can, but how can they make all of these payments that you guys were talking about? I mean, how do they?
Well, again, it comes down to establishing, that's where I come in.
Yep.
It's the cash flow issue. First thing you do is write down your goals. Don't worry about retirement unless it's real close. But, okay, what's my what's my goal? I want to get out of debt. I want to pay off this. I want to get my credit score back up. I want to move from this apartment to a better apartment, whatever it may be. Be able to start putting money away for retirement. You write those down and you look at those every day. Then you write down your income. Where's my income sources coming in? Then you look at your expenses. And you look at your essential expenses. You know, utilities, water, heat, rent, car, food. For the kids too, gas.
Yes.
Then you look at, you know, some people consider the iPhone and all the other stuff essentials, and I guess that is. But you can say, oh, do I need this great texting plan? Do I need all that stuff? You can save money there. Then you look at, okay, what can I get if I have it and I haven't used it in a couple of years? Can I sell it to get some money to help get in? Then you track where you spend your money. I track every dollar I spend. And the reason I do that, because I asked a client to do it, and then she turned around and asked me, do I do it? So I do it. But it really opened up where you spend your money. If you do it for 30 days, you're going, wow, I spend that much eating out. I spend that much on sodas or
Yeah, if you cut back on
Starbucks.
Starbucks.
$4 a day in Starbucks. You took that same money, set that aside, at an 8% return. Over 20 years, would be $48,000 on about 20-some thousand of spending. It's only $4 a day.
But it's so
But it's
good.
47, it's 2,700 a year. Multiply that on out. So just prioritizing what's important. You know,
Well,
one
you-
Starbucks, okay, but 4 a day, a little too much. That's what you do, is you go back to the basics. And you look at, now if you got debt and you want to pay it off, how do we pay debt? Who pays their debt on credit online? Who goes online and pays it online? How often you pay your debt? Once a year, once a month? Yeah, but it doesn't seem like it goes away, does it? Interest on credit cards and debt is compounded on average daily balance. So if you go in every Friday or so, you took the $5 a day you didn't spend on Starbucks, and you put it on your credit card, that's an extra 25. The next, it's an extra, and it goes, well, you know, when you get a bill, you got 4 payments, and then it's down some. The credit card doesn't like that because it's eating their interest.
It's a way to manipulate it.
Yeah, but you're in control, and if you can't make a payment 1 week, okay. But you're always getting ahead, if you keep a bad month, you're a little bit ahead of that month's payments. That's the way you get out of debt. You put yourself in the driver's seat, not wait to get the next bill. Go back and look at last month's, your credit card you're gonna get in April, or look at last month, in March's. Look how much you paid in interest. And depending on it could be $10, it could be $40. If you can cut that discount in half, that's money that's back in your pocket that you can then use to build up your other goals, be it a cash reserve or building for that longer reserve fund, or even to get into a newer car or to get into a house. Because I know right now, we used to in the 2003 through 2007, it was, what I call the ninja loans. Who knows what a ninja loan is?
No income, no asset, also called a liar loan.
Well, no income, no job, no income, no assets.
Yeah, I was wondering where the J was coming in. It's called a Nina, but no income, no asset.
Did they make those anymore?
No.
But the other thing is, when you get a mortgage now, PMI never goes away.
On FHA.
And FHA, it never goes away. Remember the old rules where they went away, you paid down 20%, or 80,
Right.
so you had 80%, 22%, thank you, to home loan to value. Well, it doesn't go away. You'd be paying for 30 years, you're still paying that payment, which could be, I saw one the other day, it was $137 per month.
Wait, Gary, let me ask you a question. Is it a good idea?
That's your IRA right there.
If you have equity
Mhm.
in your house, is it a good idea to pay off your credit cards? Because what she was asking is if I'm swimming in credit card debt, I just can't get out of it, because one thing that's not changing is my income,
Well, if you don't change your habits, you're gonna be right back there.
right?
That's his point. He says, and what I heard, what you said in very short order, is that you've got to change your spending
That's right.
habits,
You gotta
and
watch
you've
it.
got to change the way you pay your bill habits, okay? And you've got to make a solid commitment to do that and execute it.
Because you didn't get into a bad situation, most people don't, at one or two events. Yes, I mean, if a medical issue, a fire in a house, something like that, lost a job, could be. But a lot of the patterns, it started because you bought 5 Starbucks instead of 3 or 1. You bought the car, oh, let's not get the car that's 1 year old, let's get the brand new car. I say that because I'm shopping for cars right now. But it's the habits that get you in trouble. It's the habits that get you out of trouble.
All right, and what about the kids that are just graduating from college and they've
Do not
messed up
co-sign.
everything?
Do
What
not
would
co-sign.
you all say to them?
Well, I'll address that. We've really become champion enablers to our children. We have 4, and they're all in their 20s. And we made a mistake, and we didn't really sit down with them, and neither did my parents. They didn't sit down with me and say, okay, here's how you do your checkbook. Here's how you reconcile your checkbook. And here's how you handle your money. Everything was a secret when it came to money with my parents. Most of the time we don't have any. And I'm not even sure they knew my name, so back in those days. But at any rate, we, in the town I live in, I'm involved in the Chamber of Commerce. We just, one of our board members had a brilliant idea to form a junior Chamber of Commerce for the high school. So we're going to launch that next month. We're going to have the sophomore, junior, and senior class is going to kick off their junior Chamber of Commerce, and they have a wonderful economics teacher out there that is going to have them shadowing different businesses around town, and they're going to start learning things about how to handle their money and how to run a business, and they're going to how to meet a payroll. They're going to learn some stuff while they're in their youth, so that they can know how to handle these things as they become adults. Maybe have an opportunity and a better head start than what we had.
But John, if one of your children is upside down in debt, what's the first thing he can do if he, is struggling, if you have all of these bills you guys were talking about, where does he start to get out of that?
Well, he got to change his spending habits. He can't be smoking, he can't be drinking, and then coming to us for help.
That's parents, that's parents.
He really needs to use his youthful energy to get an additional
Yeah.
job.
That's right.
That's great.
I'm just using those as examples, okay? And I have 4 children, so I don't have to tell you which one that's doing that, okay? And I'm not talking about somebody that just goes out and hangs out in bars. I'm talking about just, my wife sees, if she goes in their house and sees 1 bottle of wine in there, she's going, there's no way I'm buying baby diapers for you guys if you're wasting it on wine. You see what I mean? It just upsets her. So
Well, that could be
you
Starbucks.
can afford wine,
it
but you
could
can't
be
afford
all
you
kinds
can't
of
afford
whatever.
baby formula. That's just one thing. But so you have to look at the spending habits, and then you got to look at the way that if they're willing to sit down and let you go through the way they're paying their bills. Most of them don't. If they're grown, they don't really want you in their business anymore. Somebody else. It really takes for parent to child. It really takes somebody outside, like a mentor, somebody they have respect for, to sit down with them and tell them, hey, this is the way to do it. You can't, it's just difficult for
I
a
end up doing
parent.
that with a lot of my clients.
You know what I'm talking about?
Well, that brings me to a question. I talk to a lot of people that do not hook up with Eric. They hook up with somebody who maybe is less reputable, not certified, and spend some money on what they believe is credit repair, but ultimately turns out to just be
Bingo.
wasted money.
Yeah.
Eric, can you talk about how a person can assure themselves that they are working with somebody who's certified and reputable?
I'm unfortunately with Google and things like that, if you do a search on credit repair, you're going to have a slew of top credit repair industries in the nation. If anybody in the room's seen that and gone online, you can find them. They all, I looked at them just recently, a couple weeks ago, top 10. You can go through them. And I looked at their programs, and they do work. Most of them, they usually will get you on a monthly reoccurring payment structure, And the whole, I'm not going to say this is their goal, but essentially for them, you are a stream of residual revenue. I know that kind of steps on some toes, but that's just how it is. Now, there are ways that you can fix your own. It's just a lengthy kind of experience. Does that answer your question? I don't know if, as far as reputable.
So are you saying there's a payment plan that would tip you off that this is a good way to do it, or?
Well, I don't know if
Is
there's
there
a way.
time frame or
Yeah, I mean,
limits, things like that?
I'm not trying to pitch myself, but see, we do everything in 30 days because we have the proprietary software to do so. These other companies, they're doing what they say they're going to do. It's just, it takes a long time. So as far as identifying a reputable one, I would say do your homework and do your research on the company before you commit or give them access to your bank account.
Check the
That's
Better
direct
Business
enough.
Bureau.
Better Business Bureau as well,
Yeah.
absolutely.
I have another question. When you mentioned 5 of the exact same thing, five
Yes.
Wells Fargo
Duplicate.
credit
Bankruptcies,
cards
duplicates,
with
yes.
exactly the same account balance, or 5
Correct.
bankruptcies, how would a person go about fixing that one thing on their own?
If you have an error on your credit report or a mistake on your credit report, the first thing that you want to do is you want to contact the credit reporting firm that actually produced the report and tell them that you're challenging the item. The unfortunate problem is you have to do that in writing. They have to receive it in writing. You have to challenge the actual bureau firm or send them the letter of saying, I am disputing this on my credit report. You need to fix it. This is an error. You have to include documents that document your support your case, and don't send original documents, please, because I don't want to say they'll shred them and then say sorry I lost them, but you want to always send copies. You want to keep the originals for your records. They are required by law to investigate them, and by law they're supposed to respond in 30 days. The reason you want it in writing, just kind of some insight. If it is filed in the U.S., it stays in the U.S. If you call the bureaus and you want to talk to somebody, they will outsource your phone call and they will give you the runaround. They'll take your phone call for 2 to 3 minutes, and really the bureaus have us classified in 2 segments. Either you're a judge, you're a politician, or you're some sort of celebrity. Hi, I'm Angelina Jolie and I have an issue, and they fix it. Or you're, hi, I'm Eric Wheeler, and they outsource you, and you're there for 2 to 3 minutes, and they say they've addressed it, and nothing ever changes. So it has to be in writing, and you challenge it. Then they have to get back to you in 30 days, and they need to get back to you in writing as well, because then you have the document for your records. If they find the information, it wasn't accurate, they have to legally correct it. And that's kind of where you can hold their feet to the fire. This needs to come off. If they refuse to correct it and they kind of brush everything under the table, then if they don't resolve the dispute in your favor, I'll say it like that, you can ask to have a statement put on your bureau disputing that item, including future credit reports. Meaning, if you see something that is a duplicate, they go back and say, well, we're not going to look at it, it's fine. They did their research. And you say, well, I want to put a dispute on that. And they usually give you X amount of space. I don't know if it's 4 sentences, whatever you want to make sure it's just a sentence. I've disputed this and this is incorrect, just something so that when someone pulls your credit report, they pull it up and they see that you've disputed that because that's not accurate, and they can actually approach you and talk to you about it. Now, if you put a 4-page dispute on there, when he sees it, unfortunately, most people just won't take the time to read your statement. I'm not saying him, he probably would, but everybody else, let's be real, they're not going to read that.
Josh,
go ahead.
once I've put something on my credit report that's disputed, and you're doing my mortgage, how does that help me?
That actually, Fannie Mae and Freddie Mac, those are the major lenders in mortgage the world, and they will not accept a dispute because what I've heard is they interpret that, or the systems, the FICA system, might interpret that as they can't tell if that dispute is altering the credit score or not. And so it could alter it in your favor, it could damage your credit score. So the word dispute has to be removed for a mortgage, actually. And one thing that you can do is that if you, now this is not advocating, most mortgage companies, if you pull up, they offer a credit service, okay? And we can do what they call a rapid rescore. And what that means is, hey, look, I paid that account off, that's fixed, can you go ahead and get this updated for me? Yes, we can do it in 7 days rather than 30 days, if you have the documentation that says that, okay? Now, Eric, he might need to see it first to make sure we're doing something correct, but things can happen a little faster rather than waiting for the bureaus to get back to you. And I love the fact that he says in writing, because you need that paper trail, and you also need to not be outsourced,
Right.
where someone's not held accountable to your account,
Right.
to helping you.
And that was in the New York Times, by the way. You can look that up. As far as there are two different. If you're not a judge, celebrity, or politician, ours gets outsourced. To do that question, I'm sorry.
If you dispute a score or
Yes.
something on the FICA
Yes, ma'am.
printout, does that agency, whether it's Equifax or TransUnion, do they report it to the others, or do you have to go through the same process with the others, if indeed it shows up on those reports?
If it comes off of your report, the next time that they go back and they're supposed to purge the records, when they do that purging process, if they go back and verify that it's gone, then it should report to all of them. Now, does it always? Probably not. I mean,
Yeah.
unfortunately, I don't think they talk as much as
No,
we like to think
they
do.
don't talk to each other. They're separate entities, separate different
So it's our
entities.
responsibility.
Yeah.
Eric, I have a
Yes.
question. What about on collection agencies? When you have paid off a collection, do they automatically take those things off your report, or they do not? You have to fight with them to get that off.
You have to file it in writing, and you have to go through. The real problem with collections is they get sold so many times, it shows up so many, and it's the same account, but it'll look like a duplicate a lot of times.
So say it started with T-Mobile, say it was your cell phone bill, your electric bill from the previous place. You forgot you had a little balance on there,
Right.
and that little balance, $30 could turn into $500 over years, because it's sold to this account, and they add their fees onto it, then they sold it to another company, and they add their fees on it. And then it just, how do they do that? Is there a rule of how many times it can be duplicated and how long it can last?
I don't think
Is
so.
there a rule? So
I don't think
the
so.
7-year or 10-year rule, does that apply to those?
They're supposed to, again, if the bureaus, and I hate to say they're not doing their job, if they were purging their records as frequently as they're supposed to, things are supposed to fall off. Bad accounts, outdated
Do you remember
accounts,
those
bankruptcies.
timeframes?
Bankruptcies are 10 years. I believe judgments, I want to say foreclosures are 7 or 8. Maybe you probably know better than I would, actually.
A contract has a 7-year statute of limitations in the state of Tennessee.
Oh, okay.
Good.
So,
Good.
and then a judgment lasts for 10, but can be renewed for another 10.
Wow.
Judgments can also attach to real property that you own. If you then file bankruptcy, you've purged your personal liability for the debt,
Mhm.
but the judgment is still attached to the personal property.
How does an
Public
IRS
records,
thing,
right?
is that forever?
It's forever.
Okay.
Even if it's uncollectible, they say we can't collect it because let's say you're disabled for some reason, but they still charge you interest, and you can't work out a payment plan. You gotta come up with, and you can't even get a loan because the credit bureaus won't, or credit unions won't give you a loan because you got a lien, an IRS in it.
Federal Credit Union.
So you're in a catch-22 when it comes to the IRS.
Yeah. So,
They will negotiate though.
okay.
They will negotiate payments, they will negotiate payoffs, they want to see every.
Normally, but if they consider it not collectible, they won't talk to you. They just want it all up front. I've had 4 cases like that.
Wow.
They're mostly veterans.
Wow.
Real.
It comes up a lot in my office when someone is selling.
Mhm.
And they're selling their property, and the IRS lien is now attached to their property. And we can produce a lot of documentation and give them either a percentage of it or get a partial release for this one piece of property and make a big chunk.
So what you're saying is that if you have an IRS lien or a judgment, and you have a house and you're going to sell it. Now, they can attach a lien on your house, and so when you go to sell it, is that what you're saying?
Yes.
That lien has to be paid off.
It has to be released.
Released, at least.
It has to be released in order for that property to travel to the new buyer.
So not only paid off, you gotta have.
Not necessarily paid off.
You just gotta.
It's got to be released.
Released.
So it may be a $400,000 IRS lien, and we're selling this piece of property. We inherited mom's property.
Mhm.
Right.
And it's a $150,000 piece of property. Well, once I inherited it, my $400,000 lien attached to mom's property.
Wow.
It's pretty devastating.
Yeah.
And then we talked to the IRS and explained, this is all there is. And they want that property to move. And so they accept some portion of the proceeds, or maybe all the proceeds, and they do a partial release. I still owe the IRS $300, but mom's property was able to get sold and continue to be taken care of.
Awesome. Any other questions that you guys can think of, or did we answer some of your questions? Or all of your questions?
Let's go back to where you're saying this thing is sold to this critic, or this person is calling you, and sold to the next person is calling, sold to the next person is calling you. Each time it's sold to someone, doesn't that make your credit score go down, down, down?
Absolutely.
Because
it'll show up again as it won't necessarily show up as a new account, but it'll show up that it's timed out with that one and it starts again kind of thing.
And from my perspective, I think it becomes harder and harder to get that thing paid off.
Yeah, it's harder to track down, for sure.
Yeah.
For sure.
Part of that is, my experience in past years, is it would be a medical bill,
Correct.
either physician or a hospital,
Right.
and you would pay it off. The
Mhm.
insurance would pay and you pay the copay, and yet the hospital or the practice was sold to somebody else,
Right.
and they started billing you.
That's when you
So
need
you have to
a
keep your receipts saying that
right.
you.
You need a professional to get involved because they essentially you need an attorney on your side because then what they do is they go to bat for you and they say this has been
But
sold.
then you
Here's the
have extra
information.
money to pay out, you don't have it to pay out.
Right. Well, you need a credit repair person on your side.
But keeping your receipts is going to be
Absolutely.
vital
It's gonna be
for
vital.
either the credit repair person or the attorney.
Right.
And those medical records or medical bills, we have also found that they will almost always take 20% off if we just ask.
Wow.
If we want them to take more than 20% off, we've got to produce we've got to show our financial underpants. We've got to show every account we have, what we're selling the house for, in order for them to release the lien or accept some lower payment. But they'll almost straight off the board just take 20% off just if we ask.
Best advice my accountant ever gave me was keep good records.
Absolutely. Absolutely. Go ahead.
One thing we haven't talked about is talking about fixing credit or anything else. Is I hear a lot of guys, should I cash out my retirement account? Should I take a loan against my 401k? Should I, do this to get out of it?
To pay off.
To pay off your credit card, yeah. Your credit card, let's say worst case is 20%, 24%. If you take out an IRA below 59.5, you're going to give it a 10% penalty, plus it's going to be added to your taxable income.
Mhm.
If we're lucky, we're looking at, 15% bracket, you may push you into the 25% bracket. So now, for every dollar you take out of the IRA, you're now being taxed at 35%. Look at it as 35% interest due in 1 year. And depending on when you take it out, it may due in 4 months. If you take money out in December, the bill is due in April. As compared to 24% interest that over a longer time.
Right.
Plus, you're not even thinking about the future value of loss market. If you took money out in 2009, at the bottom of the market in March of 2009, let's say you took 10,000 out, today that 10, with just staying in the market, would have doubled.
So what is the strategy when you have your 401k, you're putting your 10% in, it per se 5, 10% or whatever your 15 max, right? You're contributing to your 401k, but now something happened, you have a high credit card debt now. What do you do? What do you snowball it? Do you pay off the lowest one first usually, like Dave Ring
Well,
talked
there's
about?
different, you gotta find what makes sense for you.
Okay.
Because money is an emotional issue. Just ask any husband and wife. It's an emotional issue. The snowball is one strategy that works.
Pay off the smallest one first?
Right, it is some emotional value. But also, if you look at the small one, is, is $500, and the next one up is 1,000, but it's twice the interest rate, I'm paying off 1,000 first.
Okay.
Now I'll go back to the 500. Now, if you're talking bigger difference, it's a little different numbers. But it all comes back to is prioritizing your goals and your budget. But if you need to cut back on your savings, cut back on your savings to pay off the debt and then get back into it. But I would not stop investing, especially if you're getting a match. If your employer match, go for the match and the rest you put
Right.
aside. Because even when you pay off your debt, you're still gonna retire.
Yeah, it's free money.
I haven't done this in a few years, but some success a few years ago, calling a credit card company and saying, even while I had a balance, and I think a lot of people believe they can't cancel their credit card, terminate their credit card until they've gotten it paid off. Got a huge balance on my credit card, and I called the credit card company and say, I want to close this card, I want to cancel this card. Well, they don't want me to cancel the card, and they put me on hold for a really long time. And I stay on hold until they come back on the phone. They didn't get rid of me that easily. And then I start talking to different people. And finally, someone offers me a lower interest rate if I'll keep the credit card open.
Yeah, if you're trying to improve your credit score, remember, it's all about history. And so you want to maintain that history and not close it. So that's a good strategy.
I wasn't really trying to close it.
Yeah,
I
right, that was a
trying to
good
drop the
strategy
interest
about
rate.
interest rates. That's a good strategy. Sir, you get one more question? Anybody?
One more question, if you don't mind.
Yeah.
If you look at a credit report there, and it says, charge off account closed, what does that do?
Well, in my opinion, I'm not the credit
Go ahead.
specialist, but over time, it lessens. You know,
Okay.
over time, you outrun that. And if you get good accounts, new accounts, like your secured credit card and so forth, that new good outweighs the bad. It will start rising on the other end.
And they're supposed to time out just like the other things. Now, quickly before we end here in a second, so we talked about going straight to the bureaus. The other one after if the bureau doesn't successfully remove it, you obviously put the dispute on there and request that they put that on your report. After that's happened, you go straight to the lender who's asking who was responsible for reporting that to the bureaus in the first place with your documentation again. If they go back and see that the debt has been paid, it's their responsibility as the lender to report that to the bureau. So that's kind of the
And do that with
gist.
duplicates as well.
Yes, absolutely, duplicates as well. So quickly, kind of in the last 60 seconds, how to repair your credit, obviously, and start getting your credit score up. Good utilization of your credit lines, between 10 and 30%. Don't be late on payments, stay current. Don't close accounts, obviously, the history that we talked about. Don't have unnecessary inquiries ding you. Don't go out and just start opening a bunch of different credit lines. And then obviously get your credit repaired and get on the track to get this all addressed quickly and make sure that you're in connection with who you need to be to address these issues.
And I would add, don't leave your head in the sand.
Right.
And
Yes.
communicate with the people that you need to be paying off. Communicate,
Absolutely.
be open, be honest, do what you can. Communicate, communicate, communicate.
Be cautious with car dealers, they will pull your credit and 11 times, they'll shop
Yes.
to see who will give them the best rate, because they get money on the back end of the deal.
And my point was getting, prioritize your goals, work on your cash flow, and budget. I'm a big believer in debt is a tool. Don't let it control you, you control it.
Absolutely.
Prioritize what's important to you. And going back to you talking about communication, if you're married or you're in a relationship, the biggest person you got to communicate is the person in your relationship, whether that is a adult son to a parent or husband and wife.
Awesome. communication. Wonderful, guys, and thank you so much for Williamson County Library having us here, and thank you everyone who's on the panel. Thank you very much.